Hey, everybody. Welcome to the podcast. Thank you for joining me. It's the weekend edition. Appreciate you joining me here today. And for those that are new, basically what we do is we go through the markets. We try to point out stuff that either people are talking about that are impacting the markets. And obviously we take questions and comments as well. So if you have questions or comments on the podcast, just email carl@eggerscapital.com and we'll try to get to a question. All right, so here we are approaching the end of the year, and the stock market finished the week on a pretty good note. We had some better than expected employment numbers yesterday, and investors have been pretty nervous lately. There's been some mixed data. I mean, if you look at the number of economic indicators coming out that were good versus the ones that were bad, it's actually been leaning more towards bad lately. However, I think one thing that people miss in that is that you have to weight them, right? There's certain economic indicators that are very important and other ones that are not so important. So it's a matter of weighting them. And basically, we know a couple of things. We know that the stock market is highly correlated to the jobs market. And it's not necessarily the quality of the jobs or anything like that. It's just the pure raw numbers, whether they're made up or not, whether they're and a lot of them, basically because of the way they calculate it, I won't say they're made up, but they are massaged. Let's put it that way. But regardless, the fact that continues to improve, investors continue to like that. Yesterday, I actually thought was encouraging because we got a good economic report, and the stock market actually went up. When you get some good news, the stock market has tended to fall, and it's because obviously they're worried about if the economy is improving, the Fed will step out of the way. But that's what we want. We want the Fed to get out of the way, let the economy go on its own. And is it strong enough to go on its own? I think it is, because the fact that the quantitative easing isn't doing anything to help it. So they might as well get out of the way. But regardless, the stock market had been going down 4 or 5 days in a row before yesterday. And you can see on the chart here, had a nice up day. S&P was actually up over 1%. Dow Jones up over 1%. The thing that was a little concerning, I think, is that you looked at small and mid-cap companies and NASDAQ. Those were only up 0.75%, so they underperformed. Usually on a big, strong day, you would expect them to outperform. So internally, it wasn't as good a day when you look at that, where the leadership came from. When you look at the overall just supply and demand, the intensity of the rally, it wasn't that strong of a day, but it was a good day. And I don't know if, this was the bottom on Thursday, and off we go here. Because again, in the short term, we're starting to see some selectivity. You're starting to see some of those go-go stocks that were, you just couldn't lose with the beginning of the year. They're starting to suffer a little bit. But overall, again, it was a pretty good day if you were an investor in the stock market. So if we take a look at basically what's going on here with the S&P 500, we had basically broken out of this little channel we had been in, right? We were in that channel for a while, and we broke out of it, and we came back and we tested it, and we went up to another high, and it looked like maybe we're going to come back and test it again, and maybe we still will. But for now, it stopped at the 20-day moving average. That's the green line here. So it's bounced off of that. This will be the second time. So are we just going to do this? I don't think so. But there's no signs that we're going to have some significant pullback. I think, if anything, if you were looking for a larger pullback, I think the odds are we would have one at the beginning of next year, in the first quarter of next year. Just simply because things tend to, as they run up, they tend to run up through the end of the year. And I think that's what we're going to see, is this kind of Santa Claus rally go up to the end of the year. Some other positive news is could be a budget deal, maybe a minor budget deal, but have you heard anything about it on the news? I haven't heard anything about it. You have to dig around to find anything about it, and that's actually good, because when you hear about it on the news, it's usually politicians trying to make their case and trying to get the public on their side and using the cameras for negotiating, and we haven't seen that lately, so it may not be some huge deal, but the fact that that's not a negative is a positive, and I think the stock market and investors are embracing that, and embracing the fact that maybe the jobs market is mildly improving. Again, we've talked about we need much more than 200,000 jobs per month. We need at least 250, if not 300 a month. And, they're simply not there. But again, the general direction is improving. It's going up. And the number of jobs going up, the unemployment rate coming down. And even the participation rate which a lot of bears will point to, that actually was up last month. So we'll see. These numbers get revised all the time, so you can't take one piece of data and assume that it's going to continue or it's the most important. There's a lot of different things to consider when you're looking at the whole economy. But anyways, we did bounce off of that, and so again, as we broke out of this channel here, if we were to come back into it, then you might get concerned, and certainly if we broke this purple line, which is the 100-day, because that's what we've been bouncing off of. The 200-day hasn't come into play at all. In fact, let me zoom out a little bit, and I'll show you what I'm talking about for the whole year. The 200-day has not, come into play at all. That's been the market's been plenty above that. In addition, the 100-day has been the thing that you were to look for the bounces off of. So could we have come down and bounced off of that? Potentially. That would have been in the 1750 range, something like that, 1725. So that the odds would favor that at some point. But again, look at the moving averages themselves. If you look at the moving averages themselves, you'll notice that they're still moving in the right direction. And this is an interesting way to look at the stock market, by the way. We get caught up in the day-to-day trades and some of the news that comes out. But if you simply stand back and you take, and I've got 4 different moving averages. I've got a 20-day, which is the most sensitive in the green. I've got a 50-day in the blue, which is a very common one. 100-day, probably the least common in the purple. And then the 200-day, which is another common one in the red. And all I've done is just taken the price of the stock market and taken it off the screen. And so all you simply see is the big picture, right? And in its most simplistic form, what you're watching for are these things to start rolling over. For example, last fall, we had a pretty good sell-off. And during that time, during the September, October, November, remember during the fiscal cliff time, the market sold off quite a bit. I think it was about 10% of a drop. We haven't had that this year. But the moving averages, you can see, were starting to get a little clustered. They were starting to cross each other. We're not seeing that right now. All these things are pointing up in a healthy direction. So again, just from a simplistic standpoint, watch that. Now let's take a look at the Russell 2000. The Russell 2000, kind of in the middle of this channel here. You can see it's not overly extended, which would be up here. It's not at the bottom. But again, look at the moving averages, all going the right direction. Just ho-hum moving along there. As we take a look at the Dow Jones, a little bit different looking picture than the rest. What's interesting about the Dow, and again, it's only 30 companies, but it's quoted on TV. It bounced off of the 200-day moving average, but it had broken this trend. It looked like it could have fallen a little bit further. Then it comes back strong and goes and breaks out on the upside. So it's a little bit different picture, but again, bottom line is the stock market has been in this methodical pattern for most of 2013 of zigging and zagging back and forth, and maybe the zigs and zags are becoming a little more closer together. This one ran for a while, and then we pulled back, and we didn't go all the way down. We just simply rallied back. So again, I'm not saying that this is the sell-off is over. I could see it happening, but perhaps it's delayed for a few weeks as we go into the new year. If you look at Treasury rates, we talked about this a while back. I'm still short Treasury rates, I'm still short bonds, long-term Treasuries. So I believe that interest rates will be going up. The reason I think that is A, because of the pattern, B, because of the data, and C, it's kind of feasting of it on itself. And so what we've done is we actually are short the bond market in our income strategy as kind of a hedge against some of those income-producing things that we want to keep that may be falling in price. But you can see we obviously had the huge run-up from May until September, when we went almost to 3% on the 10-year Treasury, and then it gave a little bit of it back. But once it broke out, which was right here, that was your sign that perhaps we were going to move a little higher. And so now what's happened is it's going up, pulling back, going up, pulling back, going up. So could we see a little more pullback? Sure, but I think the general direction is going to be up. And by the way, notice that the path that it's on is not as steep. This was a kind of a lot of people getting out of bonds at the same time. This is more methodical. Look at you see the steepness here versus the flatness here. So I think that's how this could play out, is that we could probably be in some type of range, next year, somewhere in the 3 to 3.5% range. Again, barring some of these shocks, like they don't get a deal, and we obviously the economy just all of a sudden turns south in a hurry. But we have what's happening right now. The stock market is doing well, so people will continue to pull money out of bonds. Now, next year, at the beginning of the year, don't be surprised if we see some mean reversion. What that means is, things that have gone up a lot this year may come back as you get some allocation shifting, right? People that are asset allocators are looking at their portfolio, and they look at something like, let's take a look at gold. So how's gold done this year? Not too hot, right? So, but now what's happened is because the stock market's gone up, the gold market's gone down, and there may be a 50 to 60% divergence between the two, they will shift that allocation. So they have to sell stocks to go buy more gold to get their balances back in line. And that will happen in January. So look for that to happen. And that could happen with gold, commodities, coal stocks, emerging markets underperform this year, all those things. So don't assume that into the new year, the things that are working are going to continue to work. You might see just the opposite. So this is not the time to load up on stocks and completely avoid bonds, or completely avoid gold, or completely avoid tips or emerging markets or any of the other things that did very poorly this year. This is the time to start looking at those and making sure that they're still the right balance in your portfolio, and why do you own them. Now, if we look at the VIX, which is the scaredy cat index, I guess we'll call it. It's the fear index, right? Volatility. I guess volatility going up means fear. These are those little spikes we had seen, and you can see we had a little bitty one here, and it looked like it was going to continue to go, and maybe it still will. And when we get up to here and you start rolling over, again, based on the pattern of this year, that's your time to buy the stock market. That's your time to say, okay, if I have too much cash, this is when I want to buy. We haven't had that fear yet. We had fear just start to escalate, but it's not there yet. Let's take a look at oil. Oil was something we had discussed in prior podcasts, and we said it probably would find support down here at this level. We had this yellow box, and it has. Oil got down to a low of 92 or so, just under $92, and here we are at almost 98 already. And since that spike has happened, you've seen some of the refiners have been a little. They were doing very well, and then now they've started to struggle in the last few days. So watch oil as it continues to go back up, because we had seen lower gas prices coming into the holiday season, which is really good. And now you're seeing oil start to spike a little bit, kind of at a technical spot where it should have. Now, I want to go back to the stock market for a minute. We look at the stock market here, and there's a lot of people saying that this is a bubble and we're about to burst, because we have been going up and the confidence is too high, right? We have a lot of confidence. Well, we did a little research, and what we found out was really interesting. If you go back to 2003, right? 2003, what year was that? That was the year we were coming off of the dot-com bubble, the horrible bear market from 2000 to March of 03. So that was the very beginning of a bull market. It was 03. Confidence spiked up like it did now. So don't believe that just because there's too much confidence in the markets that it has to go down. Sometimes it may be just the beginning as there's people accepting what's going on. Remember, there's a lot of people out there who still haven't participated in the stock market. And it may be that they, I've talked to a lot of people who wrote it down all the way in 08 and then wrote it back up. But there's also people who wrote it down and then got out and don't know when to get back in. So, this market hasn't been fully embraced, right? But when you look at the amount of money, and this is something that's floating around Wall Street right now, when you look at the amount of money in investments that are betting that the stock market's going to go up in the future versus money market assets, the ratio is very high. It's at a new all-time high. So what does that mean? Well, if you take a look at something like the Ridex family of funds, what they do is you go into Ridex and they have a bunch of sectors, and they have these double and triple beta ETFs that benefit from the stock market going up or down. Right now, the amount of money in those funds that are betting on it going up the ratio is so high compared to the amount of money in the money market. And that's something over time has been correlated with the market. So, for example, when that gets too stretched, that means too many people agree that the market's going up and it has to fall back down. But keep in mind, something that you need to think about, and again, I'm not saying it's going to happen Now that could be too much confidence and stock market rolls over. But here's the thing. What's different now than the previous times people were this confident? Like for example, in 2007. Remember in 2007, everybody was saying, well, look how confident everybody was. That was very different. In 2007, which a lot of you were listening to me back then, in 2007, we started to see deterioration in the market much earlier on. We started to see the economy rolling over. A lot of things were forecasting that things were going to get bad. Not necessarily financial crisis bad, but they were going to get bad. We're not seeing those signs now, but the confidence is just as high. So people are assuming, well, just because the confidence is that high, we have to roll over. Keep this in mind. This is an extremely important point that I don't see talked about anywhere. Money market assets, the reason I think people are coming out of them is not just because they think the market's going higher. It's because they're paying 0%. Remember back then, if you just didn't want to do anything, you may have kept money at the Ridex money market, and it would have paid you 4 or 5 or 6% for doing nothing. Now we had higher inflation maybe, but the point is that you were getting something for leaving your money there. So there's now a penalty for leaving it in the money market, and so that money is going into the stock market. And so it's causing these ratios to be wider than normal. And so again, keep that in mind, because it's you can't just look at the raw numbers. You have to see what was going on at that time, right? For example, back then, bonds were paying a lot more. Stock PEs were a lot higher. There's all kinds of things that were worse then than they are now. So again, what we want to do is find these correlations, and we want to make sure that we continue to follow them. And the main one that's jumping out at me from yesterday is the jobs number. It's a very high correlation to how the stock market does. And again, there will be revisions and so forth, but what we got was a better number, and the revisions were higher. The only thing that was odd yesterday was the bond market actually rallying a little bit. That was a little bit strange. But the important thing was the stock market rallied. I think that's what we want. We want better news, and the stock market rallies. We don't want people to exit the stock market simply because that means the Fed's going to go away. We want the Fed to go away. Go away, Fed, and the stock market to continue to go higher based on fundamentals. Imagine that. Stock market going up on fundamentals. That would be nice. All right. Okay, hey, listen. Google+, twitter.com/Carl Eggers. You can send your questions to carl@eggerscapital.com. Eggerscapital.com is the money management website. All kinds of things on there, on iTunes as well. So thank you, and have a great rest of your weekend.